In this section, we will cover the good faith requirement and tolerances. Before we cover the good faith requirement, we want to reiterate that in the event the APR provided on the loan estimate changes by more than 0.125% before the closing, then the creditor must redisclose by providing another loan estimate. The 0.125% applies to regular transactions. Please note that irregular transactions carry a tolerance of 0.25%. Furthermore, this disclosure must be provided to the borrower 3 full business days to review prior to the closing of the loan. Now we can consider the good faith requirement. Even though the loan estimate replaced the good faith estimate, creditors are still responsible for ensuring that the figures on the LE are given in good faith. Whether or not a loan estimate was made in good faith is determined by calculating the difference between the estimated charges originally provided in the loan estimate and the actual charges paid by the consumer in the closing disclosure. Generally, if the charge paid by the consumer exceeds the amount originally disclosed on the loan estimate, it is not in good faith, regardless of whether the creditor later discovers a technical error, miscalculation, or underestimation of a charge. However, a loan estimate is considered to be in good faith if the creditor charges the consumer less than the amount disclosed on the loan estimate, as this works to the consumer's benefit. Let's take a moment to review loan estimate tolerances. There are 3 types of tolerances: 0 tolerance, 10% cumulative tolerance, and no tolerance. 0 tolerance means that the lender is not allowed to charge the consumer more than the amount disclosed on the loan estimate for any of these charges. This includes fees paid to the creditor, mortgage broker, or an affiliate of either, fees paid to an unaffiliated third party if the creditor did not permit the consumer to shop for a third-party service provider for a settlement service, or transfer taxes. 10% cumulative tolerance means that the lender is allowed to charge the consumer more than the amount disclosed on the loan estimate for any of these charges, so long as the total sum of the charges added together does not exceed the sum of all charges disclosed on the loan estimate by more than 10%. This includes recording fees and charges for third-party services where the consumer is permitted by the creditor to shop for third-party service, and the consumer selects a third-party service provider on the creditor's written list of service providers. No tolerance means that the lender is not allowed to charge the consumer more than the amount disclosed on the loan estimate for any of these charges under any circumstances other than the changed circumstances that permit a revised loan estimate. This includes prepaid interest, property insurance premiums, amounts placed into an escrow, impound, reserve, or similar account, and charges paid to third-party service providers for services not required by the creditor. It's important to note that these are just the general tolerances that lenders have when it comes to charging consumers for certain costs or terms on a mortgage loan. There may be other specific tolerances that apply to certain types of loans or lenders as well.